First, they fought crypto. Now they want to hold it for you. Watch this video until the end to get a beginner's guide to understanding cryptocurrency. Completely free, no credit card required. We didn't originally plan to make this video the way you see it now. It started with a surprising headline. Deutsche Bank is preparing to offer crypto custody. At first we thought it was a one-off, but the more we looked, the more we saw a clear pattern. Big banks, once openly hostile to crypto, are now building the infrastructure and services to store it, move it, and profit from it. Not just in the EU, not just in the US. This is a global repositioning. In this video, we'll walk you through how and why this shift is happening. What's changing on the regulatory front, especially heading into 2026. How banks are betting on blockchain behind the scenes, and what it all means for your financial future, whether you're an investor, a crypto newcomer, or simply trying to make sense of this moment. So stick around, because by the end of this video, you'll understand why the very banks that once tried to kill crypto now want to hold it for you. For those unfamiliar, Deutsche Bank is Germany's largest bank, with over 1.3 trillion euros in assets under management, and a major player across Europe, Wall Street, and global markets. They're not just any bank. They help shape financial policy, capital markets, and institutional flows worldwide. So when we saw signs that Deutsche Bank was quietly preparing to offer crypto custody services, it caught our attention. At first, we thought it was an isolated case, a one-off headline. But as we dug deeper, something interesting happened. We noticed a pattern. Other major banks, both in the US and Europe, were doing the same. Not just looking at Bitcoin, but positioning themselves for Web3 infrastructure, digital assets, and a new phase of finance. That's when it hit us. This isn't just Deutsche Bank. This could be the start of a global shift. So in this video, we're breaking it all down. Why it matters, what's coming next, and what it means for your money. Building the bigger picture. Now, Deutsche Bank's move into crypto custody might sound like a surprise, but if you've been following our channel, you'll know this isn't coming out of nowhere. Back in March 2025, we broke down the SEC's introduction of SAB 122, a game-changing update that finally allowed US banks to hold crypto under standard accounting rules. That opened the door for JPMorgan, Bank of New York Mellon, and others to start getting involved, legally and confidently. Then, in June, we reported that SocGen's crypto arm, SG Forge, launched one of Europe's first institutional-grade stablecoins, fully compliant with MyCA. It's already tradable, with BNY Mellon handling custody, another traditional player embracing Web3 rails. And of course, we've also looked at how even SWIFT, yes, the messaging system used by over 11,000 banks, is exploring partnerships with Ripple and XRP for real-time blockchain-based settlement. That's not just crypto adoption, that's system-level evolution. So no, this Deutsche Bank story isn't an isolated move. It's part of a wider pattern we've been tracking all year. You'll find links to all those videos in the description below. Feel free to dive into them after this one to get the full picture. JPMorgan, from skepticism to quiet adoption. But EU banks like Société Générale and Deutsche Bank aren't the only names on our radar. Across the Atlantic, JPMorgan, one of the biggest and most conservative banks in the world, is making surprising moves in the crypto space. For years, CEO Jamie Dimon has publicly bashed cryptocurrencies, famously calling Bitcoin a fraud back in 2017. But behind the scenes, the story is changing. In May 2025, Dimon confirmed that JPMorgan clients can now buy Bitcoin directly through the bank. While the bank still avoids holding crypto assets itself, it now gives access to crypto-linked investment products, including spot Bitcoin ETFs, to both wealth management and trading clients. At the same time, JPMorgan's internal research team is quietly re-evaluating crypto's role in portfolio construction. They're acknowledging that while Bitcoin may not produce income, it might play a role in modern diversification, especially in an inflationary environment. This isn't a full public embrace, but it's no longer rejection either. It's strategically calculated positioning. Let clients access crypto, Stay hands-off on custody and stay compliant, but quietly build your own blockchain. We know that Connexus by JPMorgan has launched a USD JPMorgan deposit token, JPMD, on public blockchain as an alternative to stablecoins. You can check this on their own website. We've put the link in the description too. So when a bank like JPMorgan makes this kind of pivot, it's a signal that mainstream financial adoption is not just theoretical anymore. It's happening, gradually and strategically. And they're not the only ones. Up next, we'll look at which other global banks are forging blockchain partnerships, launching digital custody platforms, and quietly laying the groundwork for 2026 and beyond. A global pattern: more banks quietly embrace blockchain. It wasn't long ago that most banks dismissed cryptocurrencies as risky, speculative, and even potentially linked to terrorism. Some even went as far as blocking customers from purchasing crypto with their cards or accounts. Several of our team members, and even their friends, at BFR Consulting Services experienced this firsthand, but we won't name and shame the banks that blocked our legitimate transactions. Back then, Bitcoin was seen as a threat, not a tool. Fast forward to now, and the story has changed dramatically. Instead of fighting crypto, many banks are now embracing its underlying technology, blockchain, quietly but decisively. And it's not just isolated moves by a few forward-thinking institutions. There's a global pattern forming. Deutsche Bank is setting up crypto custody services. JPMorgan is offering clients access to Bitcoin and crypto-linked investment products, and has launched its own blockchain and token, JPMD. BNY Mellon, one of America's oldest financial institutions, has developed a crypto custody platform that, by 2025, became the custodian of choice for major institutions, including SocGen's USDCV stablecoin. HSBC is working with Fireblocks and Metaco to test and custody tokenized assets, including tokenized securities, on public and private blockchains. Standard Chartered is doubling down on its crypto division, Zodia Custody, serving institutional clients across Europe and Asia. ING Bank in the Netherlands is experimenting with DeFi for corporate treasury management. Goldman Sachs is quietly advancing its digital asset desk and considering launching tokenized bonds on permissioned blockchains. At first glance, these moves might seem isolated, but collectively, they signal a systemic shift. Traditional banks are no longer opposing crypto. Some might say they tried to kill it and failed. Now, they're preparing to control the rails it runs on. This isn't happening by chance. Many institutions are timing their infrastructure and full-service rollouts for 2026, coinciding with the fact that the EU's MiCA regulation is going fully into effect, and US agencies, like the OCC, and lawmakers, are providing regulatory clarity on crypto custody and services, including measures such as SAB 122, the Genius Act, the Clarity Act, and others. There is also mounting pressure from private stablecoins and central bank digital currency, CBDC pilots. Let's also add the growing client demand from family offices, hedge funds, pension funds, and retail investors. So no, this isn't just Deutsche Bank or JPMorgan experimenting in isolation. This is a coordinated global repositioning. Traditional banks are staking their claim in the future of regulated institutional-grade digital assets. Now, the big question: where does Web3 fit into this shift? Up next, we'll explore why 2026 may be the tipping point, and what this means for you, the everyday investor. Why 2026? The convergence that changes everything. By now, you've seen the pattern. Banks that once dismissed crypto are now preparing to store it, manage it, and profit from it. But why are so many of them aiming for 2026? Let's break it down across three powerful forces: regulatory, technological, and economic. 1. Regulatory. 2026 is when the rules get real. Across both the US and the EU, 2026 is a key year when major crypto regulations are expected to fully mature or take effect. MiCA markets in crypto assets. The EU's flagship crypto regulation will be fully enforced by the 1st of July 2026, requiring all crypto service providers operating within member states to be licensed and compliant. As a result, Banks and financial institutions in the EU are rushing to build compliant infrastructure and services before that deadline. In the US, the SAB 122 Staff Accounting Bulletin Update already allows banks to offer crypto services under certain conditions. The Genius Act aims to establish a federal regulatory framework specifically for stablecoins, focusing on consumer protection and financial stability. The Clarity Act seeks to provide a clearer regulatory structure for digital assets, including clarifying which assets fall under the jurisdiction of the Commodity Futures Trading Commission, CFTC, as commodities versus those considered securities overseen by the SEC. So by 2026 we expect more clarified tax rules regarding staking rewards and custody of digital assets, expansion of spot cryptocurrency, ETFs, exchange-traded funds, clearer distinctions and regulatory guidance from the SEC and CFTC on the classification of digital assets as securities or commodities, addressing different but complementary regulatory areas. Banks don't move without legal clarity, and 2026 is the year that clarity finally becomes actionable. 2. Technological. The infrastructure is almost ready. The last few years weren't just about price swings. They were about quiet progress in infrastructure. Many custody platforms like Zodia, Anchorage, Fireblocks, and BNY Mellon digital assets are now institution-grade. Tokenization platforms are launching for real estate, government bonds, equities, carbon credits. Even stablecoins are becoming programmable, transparent, and institution-friendly. Think SG Forge's USDCV, PayPal USD, and RLUSD. 3. Economic. The business cycle demands a pivot. Let's talk about incentives. Most banks thrive when interest rate spreads are healthy. It's not just about rising rates, but the combination of rates times loan volumes. Lending activity is strong, with steady demand for mortgages, credit, and corporate loans. Risk assets like stocks and real estate are rallying. Credit defaults remain low and stable. But as we move through late 2025 into 2026, here's what the current outlook suggests. Interest rates may begin to fall. But so far, central banks like the Fed are holding the line on higher for longer. Economic growth in the West is slowing, unless significant stimulus arrives via fiscal, public spending, or monetary, rate cuts, liquidity policy. Retail demand for traditional investment products may flatten, especially without a clear growth story or yield opportunity. This changing environment puts real pressure on banks to adapt. They need to unlock new revenue streams, offer alternative assets, crypto, tokenized securities, real-world asset tokens, and attract younger, digital-native investors who expect modern financial tools. But let's be clear, crypto is no longer a side project for the banks. For many banks, it's becoming part of a survival strategy. So when we say that banks are warming up to crypto by 2026, it's not hype, it's a calculated pivot. They're positioning now, because if they wait until it's obvious, it'll already be too late. Why Web3? Rethinking finance from the ground up. Indeed, since big banks and financial institutions could no longer ignore cryptos and blockchain technology, they've pivoted and decided to quietly integrate it. The question is no longer if blockchain and crypto will transform finance, but how far that transformation will go. Traditional banks and financial institutions, once skeptical, have now moved past the experimentation stage and begun quietly integrating blockchain into their systems. But while that first wave of adoption still works within today's financial structure, Web3 represents something far more radical, a chance to rebuild the system entirely. Web3 isn't just about using blockchain in the background. It reimagines the foundations of finance, who owns data, who controls money, and how trust is established and enforced. It asks, what if we could have a financial system without banks, brokers, or even borders? That's not a futuristic dream anymore. Thanks to innovations like smart contracts, digital wallets, and tokenized assets, people can now borrow money, store value, and even invest, all without needing a traditional bank account. Web3's promise is clear: inclusion for the unbanked and underbanked, personal control over financial data, faster, cheaper, borderless transactions, automation and customization via smart contracts. But with this potential comes serious risks. Crypto volatility, scams, bugs in smart contracts, and regulatory gaps are just the beginning. There's also a major macroeconomic concern. How do governments implement fiscal and monetary policies, like interest rates or stimulus spending, when money flows through decentralized, borderless networks? Web3 is not a magic fix. Like the early internet, it's messy, risky, and full of unknowns. But for millions of people excluded or frustrated by the current system, it's not just hype, it's a genuine opportunity. Web3 shifts the question from who do you trust to can you trust the code? And that may be one of the most important questions of our time. The same banks that once tried to kill crypto now want to hold it for you. Would you accept? Tell us in the comments. Should we celebrate this shift or be concerned? Sure, banks are experts in compliance, but is that enough reason to trust them with the keys to your crypto? Let us know what you think in the comments. If you're new to cryptocurrencies or not quite confident with the topic, we hope this video helped break things down in a clear and approachable way. So next time someone tells you that all cryptocurrencies are scams, you'll be able to say, "Not all of them, let me show you why," and share this video to help them understand too. If you haven't already, make sure to like and subscribe to our channel. And as promised, you'll find the first link in the video description. It gives you free access to our beginner's guide to understanding cryptocurrency. No credit card needed, just click and download. We opened this video with a simple question. First they fought crypto, now they want to hold it for you, and what we found is even bigger than that. From Deutsche Bank to JPMorgan, from MiCA in Europe to regulatory clarity in the US, traditional banks are no longer rejecting crypto. They're quietly laying the rails to run it, not to replace the system, but to rebuild it to their advantage. So the next time you hear a bank talking about crypto custody or tokenized assets, remember, this isn't a trend, it's a power shift. The question isn't if banks are entering crypto, it's whether you'll let them hold the keys to your cryptos or keep custody yourself. In this new financial system, control isn't just about access, it's about sovereignty. And if you don't hold the keys to your crypto, you don't really own the asset. Stay tuned to our channel. We'll be sharing practical videos to guide you through self-custody, because we believe that in the near future, almost everything will be tokenized. And that future requires you to take and keep control of your digital assets safely, securely, and smartly.